Hi, I'm Paul Diggle, Chief Economist at Aberdeen. Financial markets have had a very volatile couple of weeks amid the conflict in the Middle East. Events are moving quickly and the situation on the ground could be different again when you're watching this video. However, I want to do two things. Lay out our baseline and scenarios around the conflict and its economic impacts, and then step back to consider what persistently elevated geopolitical risk means for investors. We are conditioning our baseline economic forecast on a 2 to 4 week conflict with a $90 average oil price over March and then a subsequent reduction. This adds roughly 40 basis points to our 2026 global inflation numbers relative to previously and subtracts 30 basis points from global GDP growth. Regionally, these impacts would be largest in Europe, especially Germany, and Asia, especially Korea, Japan and India, which are all big net energy importers. Relative winners are the likes of Norway, Canada and Russia. The US is somewhere in the middle. We take out the March Bank of England rate cut and the June Federal Reserve rate cut from our previous projections. We put a roughly 40% probability on this scenario playing out. That's actually quite low for a baseline because of how elevated the uncertainties are. In particular, we're also modelling scenarios with significantly higher paths for oil, as the chart on the left here shows. Our conflict risk dominates scenario at 30% probability has a $120 oil price, and our even more severe stagflation scenario has an enormous increase to $180 oil. That may sound like a lot, but we think the non-linearities between the duration of the conflict and the scale of disruption in the physical oil market and broader supply chains is generally underappreciated. The chart on the right shows that some of the offsetting sources of oil supply from the Saudi East-West pipeline to the Red Sea or releases from strategic petroleum reserves still don't fully make up for Persian Gulf supply unable to transit the Strait of Hormuz. If the base case is correct, once the geopolitical shock abates, the macro narrative would return to being one of decent enough growth, slightly above target inflation, and modest further central bank easing in certain economies. The chart on the left shows that the shock would actually hardly be noticeable in global growth, at least relative to the scale of the growth hit from the pandemic. However, the chart on the right is a sobering reminder of the potential parallels between this episode and the inflation shock of the 1970s. We've overlaid US inflation today on the 1970s. A second large inflation shock is possible and would likely derail the global economic expansion and force more central banks into rate hikes. Whatever happens in Iran, investors need to get used to structurally higher geopolitical risk. This has been caused by the end of the unipolar order, the weaponization of economic interdependence, technological contestation, fraying global institutions, climate change, migration pressures, and domestic political instability. These factors are collectively pushing geopolitical risk permanently higher. The chart on the left, which plots a news-based geopolitical risk index, is one way to show this. And the chart on the right is a nice demonstration that some of the world's most critical maritime choke points, essential to global supply chains, not just the Strait of Hormuz, but also the Bab el-Mandeb Strait in the Red Sea, the Panama Canal, the Taiwan Strait, and others, sit in geopolitically fraught locations. One important market implication of all this is that inflation volatility is likely to be permanently higher. Geopolitical shocks push up on commodity prices and cause supply chain disruptions that reduce the supply of key inputs. This is in stark contrast to the predominance of shocks in the 2000s and 2010s, when the challenge was often of too low rather than too high inflation. On the left-hand chart, we show that even as inflation has normalized after the pandemic, the volatility of inflation remains elevated. Investors need to prioritize inflation protection in their portfolios. And because supply shocks push growth down, even as they push inflation up, they tend to push bonds and equities in the same direction. That's exactly what the right-hand chart here shows. US 10-year bonds and the S&P 500 are showing more frequent episodes of positive correlation. And this marks a regime shift from the 20-year period when bonds were a reliable hedge for equities. Investors will need to think about new sources of diversification, such as alternatives, commodities, and exposure to real assets. Traditional 60-40 portfolios are not going to provide that diversification in this new world. Investors may also be able to get exposure to winning sectors or themes, however. Geopolitical risk means big increases in defense spending. The left-hand chart shows announced increases in defense expenditure across European NATO countries from the old target of 2% of GDP towards the new all-in target of 5% of GDP. This may create company-level investment opportunities. And the right-hand chart highlights China's dominance in critical mineral refining and processing, with the US responding by sourcing more itself from Latin America. There is a global scramble for critical minerals, a need for supply chain security, and a push for investment in dual-use infrastructure. With government balance sheets constrained, there will be a big role for private capital in funding this build-out at the intersection of industrial policy, national security, and supply chain resilience. Thanks for watching. Please reach out to the economics team here at Aberdeen if you'd like to dig deeper into any of these themes. And as always, good luck out there.